Enterprise Finance Daily, August 17, 2026. AI Capital, Market Risk, and Digital Banking. Daily AI-powered insights for finance professionals, investors, and enterprise decision-makers. News and commentary only. Not legal, financial, medical, or official advice. Anecdotal stories are not guidance. 1. Corporate finance and banking. AI infrastructure reshapes corporate borrowing. The new space race is being financed on Earth. Corporate finance is entering an infrastructure-heavy era as artificial intelligence creates extraordinary demand for data centers, chips, power systems, and network capacity. Reuters reports that NVIDIA has partnered with 6 major financial institutions on computing finance platforms intended to raise more than $500 billion in third-party capital. The development places banks, private credit funds, and institutional investors near the center of the AI expansion. Instead of simply lending against a company's historical cash flow, financiers increasingly must evaluate long-duration contracts, specialized equipment, and uncertain technology cycles. This resembles financing a terrestrial space program, where immense construction costs arrive years before the economic destination is fully visible. The opportunity is substantial, but disciplined underwriting will determine whether today's capital becomes productive infrastructure or tomorrow's stranded asset.
Reuters.
Banks are already developing more creative structures to distribute this debt across currencies and investor groups. Amazon and Alphabet issued approximately $60 billion of bonds in multiple currencies during the 12 months cited by Reuters, helping the companies reach investors outside the saturated dollar market. AI-related borrowing accounted for close to 15% of investment-grade issuance during the period covered by the report. Lease-backed financing is also emerging, with future data center rental income used to improve visibility into repayment capacity. These structures can connect pension funds and insurers with assets producing long-term contractual income. They also introduce concentration, energy price, construction, and technological obsolescence risks that conventional corporate models may underestimate.
Reuters.
For corporate treasurers, the central question is no longer whether AI investment will influence capital allocation, but how quickly balance sheets can support it. Debt-funded expansion can increase returns when demand develops as projected, while leaving borrowers exposed if utilization, pricing, or productivity disappoints. Multi-currency issuance may reduce dependence on one market, although it creates foreign exchange and refinancing considerations. Banks must therefore integrate engineering, energy, and technology analysis into credit processes traditionally dominated by accounting ratios. Investors will likely pay increasing attention to contracted revenue, grid access, construction milestones, and customer concentration. The positive scenario is an expanding financial ecosystem capable of funding shared digital infrastructure without abandoning prudent risk controls. Subtopic: Treasury Architecture. Corporate finance teams are adopting scenario planning that connects capital expenditures, debt maturities, and operating cash flow. Treasury leaders will need reliable forecasts for computing demand and electricity costs. Currency diversification can widen the funding base, but requires careful hedging. Private capital may supplement public bonds where projects have unusual construction or lease structures. Banks can create value by combining underwriting, risk distribution, and technology expertise. Transparent reporting will become important as financing structures grow more complex. The institutions building this architecture responsibly may become the launchpads of the intelligent economy. 2. Fintech and RegTech. Digital finance moves from experiment to infrastructure. Compliance could become Fintech's greatest growth engine. The latest financial technology headlines emphasize payment modernization, treasury automation, and compliance-first product design. Recent industry reporting includes instant Euro Treasury funding using EURC, open-source payment QR standards, biometric-capable payment devices, and next-generation corporate banking platforms. These announcements do not establish universal adoption, but they illustrate where development attention is concentrating. Financial institutions want transactions that move quickly while remaining identifiable, auditable, and interoperable. Corporate customers additionally expect digital banking systems to connect directly with procurement, accounting, and liquidity management platforms. Fintech is consequently evolving from a collection of consumer applications into an enterprise operating layer. Fintech buzz. RegTech is becoming inseparable from that transformation because faster transactions leave less time for manual intervention. Recent product announcements have focused on automated fair lending testing, compliance monitoring, and AI-supported risk operations. The strategic objective is to create evidence about how a decision was made, not merely produce a decision quickly. Banks require traceable records for model inputs, customer communications, and overrides. Effective automation could reduce repetitive work while allowing specialists to concentrate on exceptional or ambiguous cases. Poor implementation, however, could accelerate mistakes as efficiently as legitimate transactions. Global fintech series. The emerging competitive distinction may be trusted programmability. A platform capable of executing payments, screening counterparties, and documenting compliance within the same workflow offers considerable enterprise value. Regulated stablecoins and real-time bank rails could coexist rather than force companies into a single settlement network. Cloud-based compliance services may also help smaller institutions obtain capabilities previously affordable only to global banks. Human review remains necessary where decisions affect credit access, customer rights, or suspicious activity escalation. In a hopeful trajectory, automation does not remove people from finance, but gives people clearer information and more time for judgment. Subtopic: Compliance by Design. Development teams are increasingly embedding regulatory requirements during product construction. Decision logs can create an audit trail for automated financial activity. Explainability helps reviewers understand why a model produced a particular result. Identity and fraud controls must operate without creating unnecessary barriers for legitimate customers. Open standards may lower integration costs and improve interoperability. Supervisors will still expect institutions to validate controls rather than trust vendor assurances. Fintech's most durable competitive advantage may ultimately be confidence rather than novelty. 3. Risk management and insurance. Predictive risk enters the control room. Can finance see the next shock before it arrives? Risk management is moving toward continuous monitoring as institutions combine transaction data, operational signals, and external indicators. Financial technology coverage this week highlighted AI products for insurance transformation, chargeback automation, and enterprise cost governance. Such announcements demonstrate commercial momentum, although marketing claims require independent validation. Insurers can use analytics to prioritize claims, identify suspicious patterns, and improve workload allocation. Banks can apply comparable systems to payment fraud, credit deterioration, and operational incidents. The promise is earlier intervention, but the governing data must be complete, representative, and legally usable. News. The macroeconomic risk picture remains unusually interconnected. Global banking coverage on August 16 highlighted elevated oil prices, slowed shipping through the Strait of Hormuz, and investor attention to geopolitical developments. Energy disruptions can move quickly through transportation expenses, inflation expectations, corporate margins, and insurance claims. These connections require scenarios that cross traditional departmental boundaries. A treasury shock can become a credit problem, while a physical disruption can rapidly become a cyber or supply chain event. Resilience, therefore, depends on understanding systems rather than assessing isolated hazards. Global banking GANFINs. AI may improve pattern recognition, but it can also generate new model and concentration risks. If many insurers or banks purchase similar systems, they may identify threats through comparable assumptions and react simultaneously. Historical training data may also perform poorly during unprecedented geopolitical, climatic, or technological events. Organizations need independent validation, escalation procedures, and human authority to challenge automated recommendations. Better models should produce better questions, not artificial certainty. The constructive future is one in which predictive technology expands human foresight while preserving accountability. Subtopic: Insurance resilience. Insurers are modernizing underwriting, claims processing, and fraud detection. Faster claims triage can direct specialists toward urgent or complicated cases. Predictive models require monitoring because customer behavior and external conditions change. Climate and supply chain exposures increasingly interact with credit and operational risk. Scenario exercises should include technology failures as well as physical events. Explainable decisions can improve both governance and customer communication. The strongest insurance systems will combine computational reach with humane service. 4. Investment and capital markets. AI optimism meets oil and inflation risk. The rally's next test has already begun. Capital markets enter the new week balancing strong AI expectations against energy and geopolitical uncertainty. Reuters reports that major brokerages generally expect the S&P 500 rally to continue during 2026, supported by AI-related earnings and corporate performance. Published year-end targets span a wide range, revealing optimism without unanimity. The same analysis identifies inflation and disruption to global energy flows as important risks. Markets are therefore pricing both expanding technological productivity and a potentially expensive geopolitical environment. Investors are effectively navigating with one telescope pointed toward future growth and another toward immediate instability.
Reuters.
Asian shares were described as trading cautiously while oil remained elevated and negotiations involving the United States and Iran showed limited progress. Energy prices matter to equities because they affect margins, household purchasing power, and interest rate expectations. They matter to bonds because persistent inflation can keep borrowing costs elevated. They matter to currencies because energy importers and exporters experience different trade effects. A technology-led earnings cycle can coexist with pressure elsewhere in the economy. Diversification and liquidity consequently remain important even during an optimistic market regime. Global banking GANFINs. The AI investment story is also broadening beyond publicly traded technology shares. Private credit, infrastructure funds, banks, and insurers increasingly participate in financing computing capacity. This can distribute returns, but may transfer leverage into less transparent areas of the financial system. Equity valuations may remain supported if AI spending produces sustainable revenue and productivity. Disappointment could become more consequential when debt, private markets, and public equities are simultaneously exposed. The responsible futurist position is neither blind enthusiasm nor reflexive pessimism, but careful participation supported by evidence. Subtopic: Market signals. Investors are watching oil, inflation expectations, bond yields, and corporate guidance. Earnings quality matters alongside headline revenue growth. Credit spreads may reveal stress before equity indexes respond. Currency movements can indicate changing expectations for monetary policy and global trade. Market breadth helps show whether gains extend beyond a small collection of companies. Private market leverage deserves attention even when public volatility appears subdued. Durable progress requires capital markets that reward innovation without disguising risk. 5. AI and data analytics in finance. AI is blurring the economic dashboard. The machines building growth may also confuse the Fed. The Bank for International Settlements has warned that AI can simultaneously strengthen demand and future productive capacity, making economic conditions harder for central banks to interpret. Heavy spending on chips, data centers, and digital infrastructure can increase near-term activity and inflation pressure. Later productivity gains could expand supply and restrain prices. The timing and distribution of those effects remain uncertain. Strong AI investment might consequently resemble overheating even when it is constructing future capacity. Policymakers face the difficult task of separating temporary expenditure from lasting economic improvement.
Reuters.
The same ambiguity affects financial institutions using AI internally. Automated forecasting can examine more information than a traditional spreadsheet, but volume does not guarantee reliability. Models may struggle when market relationships change or when source data contains hidden gaps. Finance teams require testing, lineage records, access controls, and clearly identified decision owners. Deloitte's survey of more than 1,300 finance leaders identifies scenario planning, AI, cloud capabilities, and technology-fluent talent among major finance priorities. The research also notes that returns and agentic implementations can lag adoption enthusiasm. Deloitte. +1. This creates a practical agenda for chief financial officers. AI projects should be tied to measurable operating results rather than impressive demonstrations. High-value opportunities include cash forecasting, anomaly detection, document processing, and scenario analysis. Sensitive decisions should preserve meaningful human review and documented escalation. Employees need training that combines financial expertise with data literacy. Used thoughtfully, AI can become financial mission control, helping organizations direct scarce resources toward productive and human-centered goals. Subtopic: Responsible financial intelligence. Data quality is the foundation of reliable financial AI. Model outputs should include context, assumptions, and confidence limitations. Finance professionals must retain authority over material judgments. Cybersecurity controls should protect prompts, training data, and generated reports. Performance monitoring must continue after deployment. Workers should benefit through improved tools and opportunities to develop new skills. Intelligent finance should expand human capability rather than reduce people to data points. Video description. 5 deeply researched stories covering AI infrastructure finance, digital payments, RegTech, predictive insurance, capital market risk, and financial analytics. This August 17, 2026 briefing explains how banks, investors, and enterprises are financing a more intelligent economy while confronting leverage, governance, energy, and geopolitical risks.
Geotax.
Enterprise Finance Daily, Banking News, Finance News, Stock Market News, Corporate Banking, Corporate Finance, FinTech, RegTech, AI Finance, Artificial Intelligence Stocks, Capital Markets, Investment Banking, Private Credit, Insurance Technology, Risk Management, Data Centers, NVIDIA Financing, Digital Payments, Stablecoins, Market Outlook, S&P 500, Oil Prices, Financial Analytics, CFO Technology. Thumbnail set. Base. AI Capital reshapes finance over a luminous financial district, digital globe, banking tower, and rising market chart. A. Urgency. The $500 billion AI money race, with a data center, bond certificate, and high-contrast gold numerals. B. Market tension. AI boom versus oil shock, with a split-screen chip and oil tanker, plus contrasting green and orange lighting. C. Hopeful. Banking's next frontier, with people facing an orbital financial network and sunrise-lit city. The generated composite is a visual concept only. Its embedded date and story text are inaccurate and should be replaced with the approved August 17, 2026 copy before publication. Production note: this script targets approximately 10 minutes, although exact timing varies by selected Microsoft Neural Voice and playback settings. I can provide the script and visual plan here, but cannot render the finished narrated video or stock footage edit.